Well, Matt, thanks for coming on the pod.
Thanks for having me.
Of course. Let's get straight into it. Would love to know a bit about you, your background, story to this point.
Sure. So I'm Matt Ford, founder of Sidekick. We're a digital wealth manager trying to unlock the advantages that a private bank would give ultra high net worth individuals and trying to open that up to the mass affluent segment. My background, though, has been pretty much FinTech the whole way. So graduated way too long ago now, 2008, and started off as a strategy consultant, but working for what are now called FinTech companies, but back then it wasn't even a phrase. So companies like Visa and Experian and those types of companies. Then joined the startup world in 2012, and I ran growth for a startup called OnTrees, which was a really early mover in open banking. And again, it kind of makes me sound old that open banking wasn't a phrase, it wasn't a thing at that point. We were screen scraping, there were no bank APIs, but essentially we were trying to help people who would normally use a financial advisor get a better view of their money. There's lots of companies out there now that all connect to your bank, and it feels quite a hygiene factor. But back then we were kind of pushing the envelope a bit, quite a bit. Sold that business to Money Supermarket in 2014. So that was like my first experience as quite a junior person really in the company.
What was your role there?
I was like running growth basically. Okay. So a mix of product and marketing. We were about 11 people. So like scrappy pre-seed seed type experience. But sold the business and thought, I want a bit more of this. You know, I've kind of got a flavor for what that feels like being an employee, but I want to go and found something. So set up a company called Parity in 2014. And again, it was broadly in the open banking space, but we had quite a different thesis. So we realized that there are a lot of people who were thin file, near prime borrowers who were just getting completely screwed. Traditional lenders didn't want to lend to them, and the likes of Wonga were popping up and just being extremely predatory in the space. So we had a hypothesis which was like, well, just because you haven't had credit doesn't mean you're a bad credit risk. Is there a better way of understanding someone's affordability and propensity to repay without them necessarily having had credit in the past? So we built, we think it was about the fourth ever credit bureau in the UK. So we're fully authorized by the FCA. And we were essentially starting to build underwriting models and affordability calculations using bank transactional data, which again is a lot more common now. You see a lot of lenders all underwriting with open banking, but this was pretty early in that space.
Were you selling to lenders then?
So we had two sides to the business. So we were we began primarily D2C. So we had an app which you connected your accounts to. We understood whether you were going to fall short, and then we partnered with lenders to then help refinance people's credit. So we were starting to use those models to just be more effective for the lenders. And our plan was to start to then shift B2B to C over time and to start to power kind of essentially underwriting for broader lenders. So it was one of those way ahead of its time, just got the timing right, timing horribly wrong.
Yeah, it feels like there's a few now that are kind of doing that, but you were doing it a while ago.
We were doing it ages ago. Yeah. And, you know, I always think startups are a bit of a combination of luck, timing, and obviously fortitude and stuff like that. But like timing is everything. So we were a bit too early, and I think we didn't stay alive in the right space long enough. But it was a hell of a journey. We pivoted a number of times. We ended up powering whole propositions for banks, but not even in the underwriting space. And after about 4 years, kind of got the business. It was pretty subscale, but just about breaking even. And had the opportunity to join Tandem. So Tandem acquired the business. So Tandem was one of the early challenger banks. I think they liked a lot of the stuff that we'd done, basically like very early in the open banking space. So
and just in those 4 years, how many sort of pivots?
And
like, was it like adjacent wedges, or was it like completely different within a year, or how did you?
Completely. I mean, like, it was a classic pre-seed startup story, which was you have a hypothesis, it's completely proven wrong, you lurch left, you lurch right, you kind of start to figure it out. And I think our biggest pivot was I remember like presenting on stage and meeting one of the senior guys at HSBC, and he's like, just power a whole proposition for us. So we ended up pivoting completely from D2C into like powering this whole proposition for HSBC. So it was a wandering journey, made all the mistakes that you do as a first time founder. It was never going to be that like unicorn business. And the exit was the right time. And it was interesting for Tandem because Tandem had been on its own challenging journey. It had got its own bank license. It had lost its bank license. It was buying Harrods Bank to get another bank license back. It hadn't got any customers, but it got lots of product that was in development. So bringing all those pieces together and taking a lot of what we'd built at Parity and with the bank license and with kind of the resources of Tandem felt a really good thing at the time. So yeah, long story short, joined Tandem as chief product officer there for a few years. Went on a really interesting journey there because, you know, Monzo, Revolut, Starling had all popped up at that time, and we were finding our reason to exist in a really competitive space, and replatformed a bank. You know, we moved completely our core banking system. We canned the credit cards. We launched savings. We did a load of interesting stuff.
Like a lot more pivoting still at a larger company.
Yeah, I think startups are pivoting, and even at Sidekick, I mean, we are pivoting daily. I mean, to get it right first time round, I think you're pretty lucky. But yeah, so spent a couple of years there, and then for my sins thought, hey, I'll become a VC. I think there's lots of entrepreneurs who need more operators as VCs. So joined the dark side for a few years, which is actually an amazing experience. I had a chance to join a brand new fund that had been spun out of a corporate venture capital fund, focused specifically on FinTech.
Was that opportunistic, or did you think, right, I've done it on the operator side, now I want to jump into that side, and you're actively looking at that point?
It's a hard one. It had been such a journey, the Parity Tandem journey, and Tandem was really just an extension of the Parity journey. So like 6 years of grind. I kind of needed a break. I kind of needed to not be building challenger bank, open banking-y type stuff, but still wanted to be in the space. Love FinTech. Like, felt that I'd got a good network in that space, and just fortuitously kind of met one of the GPs there, and he was like, hey, we're spinning this fund out, like, do you want to join? So so it was kind of a bit of both, really. So spent a few years as a VC, which was interesting because these were the COVID years where everything popped and everything was worth crazy numbers, and you were chasing deals like I've never seen before. But yeah, I suppose to wrap it up, spent some time at Mora Capital, which was that VC fund, and then founded Sidekick 3.5 years ago now, which is crazy.
Nice. And just on that startup to VC, back to startup.
Yeah.
What did you learn when you were an operator that was valuable when you were a VC? And then when you became a VC, what did you learn whilst you were a VC that was valuable now at Sidekick?
Yeah. I mean, I think what you think is going to be valuable versus what actually is valuable on both sides, I think is actually quite different. Because I mean, you've done a bit of both.
Yeah, that's what I'm asking.
Yeah, exactly.
It's the same
exactly.
for me.
I'd love to like compare notes.
Yeah.
So I thought when I went into VC, I thought, well, I'm a product person. I know how to build great digital product. I know what great product people are like. You know, how can we find rough diamonds earlier at like pre-seed and seed, and just get into deals in a much earlier way by having more of an operator product head, and also just having that kind of founder network, because there is always that distinction between founder and VC. You know, they may end up at the same events, but they're kind of sat on opposite ends, if you get what I mean. But actually, I think it was very different. Like, I think I underestimated perhaps almost kind of there was a lot more parallels to being a consultant, being a strategy consultant, I felt, as a VC than there was being an operator. Which was, it was very thesis. It was very kind of market opportunity. And there was like the side to the job that I didn't expect, which was sales ultimately. I mean, like VC, you're selling money, and
which is a weird thing to sell.
Completely. It's a commodity.
Yeah.
So you can convince yourself that you're selling more than just money. Particularly in 21, 22, when everything was nuts as well. So I think I went in thinking I was going to be this kind of product orientated. We'll find the diamonds. I think the reality is, spent a lot of time chasing deals, like hustling through network, hustling to try and get access to deals that, you know, were closing because, I don't know, SoftBank had a 5-minute walk in a park with them and offered a term sheet. You know, like it was silly.
Were you based in SF at that point? Or
No. So based in London.
Okay,
yeah. So Mora had 2 bases. It had a base out in the US.
Okay.
Well, I actually had 3, one in Spain and one in London. But I suppose to answer the question, what did I learn? You know, I think it was actually very good that I'd been in such a niche niche, well, I suppose specific domain space with Parity and with Tandem of open banking, core banking, like banking, that actually kind of lifting out of it started to really understand pattern spotting as much as anything and commonalities, and started to look at things with a more of like a market opportunity lens than just this is a great team and isn't this a really cool product. So yeah, really learned a lot. And I think half the role of a founder as well is raising money for a business, and if you can understand what VCs are thinking, then it makes raising money a hell of a lot easier. So definitely learned a lot on that front.
So do you think now at Sidekick that is the biggest takeaway, is the sort of fundraising, kind of being on the other side of the table, understanding how VCs think, what they want, how to position a business?
Yes. And like, I mean, in the nicest way possible as well. Like, I think the biggest danger a lot of founders have is that they think fundraising is the goal, not the enabler, and that if a VC likes it, then it must be a good idea. I think that is actually something to really caution against, because actually most of the time it isn't. You know, like you look at history, most of the time they're outliers that were the biggest businesses that nobody ever thought were good, and it took a brave person to go in early and to back kind of crazy businesses. But like, I definitely think that how to frame the opportunity, I learned that as a VC. So, you know, a VC is they're looking for team and they're looking for TAM. So they are looking for, have you assembled a group of people who are passionate about this? But not necessarily have you got the right answer today, but have you got a group of people that can navigate all those pivots, ups and downs, left and rights that you're going to go on? And then clearly, like, this market has to be big enough and interesting enough, and the economics have to make sense enough that even if you do figure it out, that you're going to land into something that is a big enough pool that you can go and figure something out commercially.
Or that they can create, I suppose, that a new market within that space, right?
Completely, yeah, which is often those big outliers, actually. Yeah.
Interesting. Yeah, I mean, my experience so far, I've obviously been running AdCliff for around a year now, but I think what your point earlier about just raising money makes you successful, like the big rounds, the headlines, is like, when I was a VC, I always thought people were chasing the wrong thing. Just because you raise a 10 million pre-seed round, you know, with no traction doesn't mean anything. I think a key thing for us in the early days was like, get revenue, get validation of the product, and build from there.
Yeah, completely. And it's, you know, and it's hard because, you know, a lot of businesses shouldn't raise. It's a conversation I'm sure that could take a whole podcast, but like most businesses shouldn't raise VC money. But there's this like singular destination that I think most people think that VC is the answer. So again, a lot of people trying to like fit their business into a particular shape of box so that it can raise VC, which is just the wrong way of looking at it.
Completely. Did you always, with your businesses, want to or think it was a VC backup opportunity, or that kind of just happened as it grew, as you pivoted? Or you focused on the VC route always?
So first time round at Parity, I had no idea. Like, first time founder, I just had seen this opportunity, and it really was a bit of an anti-Wonga opportunity, which was like, it was pretty heartbreaking, a lot of the stories that were going on there, and a lot of the technology that I was starting to get familiar with and knew could have a really interesting impact on just making that better. So I remember like starting thinking, I'm going to get social impact funding. Like, I actually just want to solve this problem. Social impact seems the right way. There's pots of money out there that would fund really great kind of initiatives with big societal impact. And it's a bit of a shame because came full circle on that, which was like, I found it a bit of a waste of time, to be honest, which is a harsh thing to say, but like,
trying to get money from the social impact. Okay.
Yeah, because they were basically like, I felt, at least at the time, that there was so much aversion or so much concern that you might have negative risk that they didn't want to take positive risk to step into early stage. Probably haven't articulated that well, but like, if you're going to be lending to people but lending more fairly, like, there's still the risk that you could lend badly and, you know, cause harm. So
at a time when you're looking at the likes of a Wonga, even though it presents an opportunity, there's always that risk of it's going to become like a Wonga.
Completely.
Eventually.
And I think even Wonga had raised some like impact or kind of societally good money in the early days. But yeah, I learned pretty quickly that basically you need to have like proven everything out and proven that you're going to have this massive societal impact before you can go and raise impact money. So started there and then went into like high net worth angel investment kind of space, because again, I thought like VC, this isn't really a VC space at the time. And then progressively you kind of get dragged up that curve of, oh, actually there's something really big here, and it's going to cost tens of millions to fund. The only people who can fund that are VC. So that was the parity journey. There was never any question with Sidekick, because so we are incredibly regulated, very capital heavy as a result. We're an AUM business, which takes time. We believe it is a huge billion-dollar opportunity that takes VC funding. So it was always going to be a business that needed a lot of capital and a lot of time, and was never going to be something that could have been like self-funded or angel funded. So.
Okay. Well, I mean, tell me about the Sidekick opportunity then.
Yeah. So as I mentioned before, we're building essentially a private bank for the mass affluent. Because if there's so many companies out there all trying to solve this problem of put your first £50 into Tesla, or get started and round up your spare change, and build a habit, which is amazing. Like, those things didn't exist 10, 15 years ago. There are some brilliant companies now that have helped people get going. But if you're 10, 15 years into that journey, and you're looking for more, you might have set aside £50,000, £60,000. That's great. Like, what do you do then to really meaningfully move the lever? Because if you accelerate and kind of fast forward and look at people who've got $1 million, $2 million, $3 million, they're not rounding up the spare change. They're not just putting it into a basic stocks and shares ISA. They are diversifying. They're using private markets, not just public markets. They're using leverage quite cleverly. They're just using a lot more sophisticated tools, and they have essentially expertise helping navigate a really complex space, which is money, but really making it tax efficient, making it as diversified, making it as kind of return seeking as possible. But that is locked away. Like, you need several £1 million, and you need to go and bank with Coots or UBS or someone like that to go and do that.
But is that a knowledge gap or like a money thing? Like,
it's a bit of both.
Okay.
It's a bit of both. So the reason that those private banks don't offer it to everybody else is partly cost. So if you have a relationship manager, or your own dedicated wealth manager or advisor, and you're dealing with all of these kind of quite complex products, it's just very costly to run. So they want bigger account sizes. Impossible, basically, in the existing way that private banks would do those types of products and services, to give it to anyone less than £1 million. But there's this like sweet spot middle ground, which is, my needs are a lot more complicated than these entry level products. They're not quite as sophisticated, or like, they don't need to be quite as complex as people who need offshore situations and that type of stuff that a private bank would give you. But I need more. Like, I need a lot more than those entry level things. And this mass affluent segment, which is the way that we define the segment, is completely underserved. They basically have a lot more money than entry level, but they are basically still living on the same tools and are kind of left to their own devices without the right advice and guidance and expertise to navigate it. So,
I might be putting you on the spot here, but how big is that market? Like, what percent of the population would fall in that mass affluent category?
It depends how you cut the data. I mean, the way that we've cut it, basically, people who earn £150,000 of income, have $250,000 of assets. Or, there's about 4 million people in the UK that squarely sit into that. Obviously, then you're looking for people who are more digitally native, mobile first, like craving something beyond just an outsourced IFA relationship, which is what some of the kind of older demographics would have. So it isn't mass market, far from it. I think our really directly addressable market is about 1 million people. But as a business, that is an extremely valuable 1 million people. And it's 1 million people who there really is a pull. There really is a pull there, because they might have Monzo, they might have Revolut, they might even have Nutmeg or something like that, that got them going. But like, what do I do now? And they're really missing that steer and that guidance, and ultimately like a more rich, sophisticated product set to be able to navigate it.
This question might be linked, I guess, but where did the idea for this solution come from, and why this problem?
Yeah. So while I was in VC, going back to, as I was saying, you're kind of taking a macro lens, you're taking kind of an over-the-top lens, and the wealth space was always one that had just completely baffled me, because wealth is clearly not solved. We have huge inequality. Like, most people, even if you earn £100,000, kind of don't know very much about money, and why should you? It's a full-time job to be able to really kind of get under the skin of this. So it felt like, or it is, a space of huge disparity, and huge disparity of outcomes as well. And so much VC money had ploughed into the first generation of robo-advisors that were hailed as the solution for it. But robos failed for a few reasons, because they basically just digitized a 60-40 portfolio, and it was just way too expensive to go and acquire customers who might give you £10,000, but just the payback was just horrible. Mm-hmm. So VC kind of written off this space of like, okay, wealth didn't really work. So I was kind of looking around what the space was, and we made an investment at Moro into a company called Drive Wealth, who are more of an infrastructure play. So they provide the fractional trading capabilities for Revolut and for Cash App and those types of businesses. So they basically drove out cost and made, through an API, it incredibly easy to buy like cents of Tesla. And most of that was being used to clone Robinhood, or build in just basic stock trading features. But actually, when you look at some of those sophisticated products that I was talking about from a private bank, that same technology could unlock a lot of those opportunities. So to bring that to life, one of the products we offer is a custom index at Sidekick. So you can take the S&P 500, but let's say, I keep talking about Tesla, but let's say you really dislike Elon Musk and you don't want any of your money going into that company. With Sidekick, you can do the S&P 499, because we don't just buy the S&P 500 ETF. We actually fractionally buy the individual components of the S&P 500, and we can take stocks out, or we can take categories out, and we can completely personalize it to your taste.
And that's traditionally reserved for the mass affluent?
For the ultra high net worths, because it's just so expensive to do normally. And it is technologies like Drive Wealth and those types of organizations that have started to enable that type of thing. So long story short, really started to kind of see, and I always think like big businesses are built when there's this big technology leap forward, which fractionalization, low cost custody, AI, those types of technologies are really now starting to drive cost out and make expensive processes and expensive kind of setups much more open. So I always think it's when there's a big technology leap forward, but also a massive cultural shift at the same time. So I kind of saw this tech leap forward coming out, and also looking at the market, going back to that thing of the problem just isn't solved. There's this huge generational wealth shift that's happening, but nobody knows what to do with it. So it felt like the right time to combine that kind of cultural market opportunity with what I'd seen as a tech opportunity when I was in VC.
And then making that jump into Sidekick from VC, was that quite I'm done, I'm gonna go straight into this, or did you explore the market a little bit first? What did that transition back to operating look like?
Yeah, I mean, it's as we started, every startup is 100 pivots all the time. So the space and the problem space was something I wanted to go and solve. Did I have the solution at that point? Did I say the day I left, I'm building a private bank for the mass affluent? Absolutely not. It was more trying to understand, okay, how do you solve that? And I remember for the first 2 or 3 months, I was looking at, is it about property? Is it about fractionalizing that, making that more accessible? Is it about taking some of these other asset classes that have been locked away? Is it just a private markets opportunity? Is it a more holistic one? So yeah, a lot of just market exploration. To be honest, just talking to a lot of I wouldn't even call them customers, just friends and friends, friends of friends, essentially just trying to understand what pain points they got, and the Sidekick idea evolved out of that, really.
And I remember watching a piece of content where you talked about not having launched and trying to raise quite a considerable pre-seed.
Yeah.
How was that process? Did you use some of those findings as this is our traction, this is how we think about it, and try to kind of package that up for the pre-seed round?
Yeah, I mean, we were quite lucky timing wise. I think I would struggle to raise our pre-seed now without writing a line of code.
When did you raise
that? So that was 2022.
Okay.
So tail end of the mania that had happened. Not to do the team a disservice or anything on it, but I think so we raised 3.3 million. It was literally a pitch deck at that point. And I think it was partly a bet on team. But also I think there was definitely something going on, and we were at the end of a bull run clearly in the markets. People were looking for the next thing that was happening at that point. So I think got a little lucky at that point. I think it'd be much harder now. I also probably wouldn't do that now either. I think one of the biggest challenges Sidekick had and has was that it took such a long time to get regulated. So we went we've just gone and raised a load of money. We're going to get the deepest regulatory permissions we can. We're going to like go and do all the hard things from day one, because we've been here before. We know what hard regulated businesses are like. So that, like,
what are they like? Just as you're onto that,
like, really fucking hard. You know, like, regulated businesses are a nightmare because the regulator's doing all the right things, clearly, of trying to protect consumers from harm. Like, that is exactly what it's trying to do. But the problem with that is, on day one, you have to have the answer, and you have to build the solution. You have to build the policies and the processes and the governance, and you have to kind of construct this whole architecture around a thing that is quite honestly unvalidated at that point. And I understand why you have to do that. You have to then obviously apply for your regulatory permissions, and this is exactly what we're going to be building, and this is why it's safe and why it's protected. But all you're lacking at that point is actual real world learnings. So some companies get regulated, launch, and it just happens to be right. It's kind of luck in many ways. A non-regulated startup has obviously already gone on its iterations and its pivots, and it's learned what can work and what can't work, where you have to kind of go through the opposite way around. So yeah, it's a blessing and a curse, really, because we raised a lot of money, which meant that we could do the right thing, go and get the deepest regulatory permissions. But then it meant that we just couldn't launch for ages. So we built an app that helped customers give us feedback, and built a community, and we were like trying to validate in as soft a way as possible, and like Wizard of Oz tests and mock-ups and prototypes and things like that. But you don't actually know whether people want something until they show that they're willing to pay for it, and they actually use your thing and continue to use it. And that was 18 months basically until we got those first learnings. So had we raised less, I think we probably would have taken more creative routes to get there.
Okay. So did the regulatory process just take longer than you expected, and hence delayed the launch, or did you go deeper than you probably needed to?
So we have quite a unique set of permissions. So we have full managing investment permissions. So we're an asset manager, not just a wealth manager, which means we can construct our own investment portfolios, which meant we needed to hire hedge fund managers on day one and like really prove that we know portfolio construction and all that type of stuff. It was pretty hard for a scrappy startup on day one. We're also regulated to do Lombard lending. We're the only ones regulated to do that in the whole of the UK. Again, you needed like everything in place. You needed a debt facility. You needed credit expertise. You needed all your credit policies written. You needed it all on day one.
Where do you get, like, as in obviously hire the right people? Is that this trick, or like obviously it's kind of a new product? How do you put that together?
Hire the right people and figure it out.
Okay. There's no secret sauce.
Exactly.
Okay.
But yeah, so like I think it was a blessing and a curse. We got the right regulatory permissions, but we didn't get the learnings early enough. Whereas, like, I think if you'd raised less, you probably would have gone not directly authorized on day one. You probably would have gone through like an appointed rep, regulatory hosting kind of
quite a common
approach.
model.
Yeah, it probably meant that we wouldn't be able to manage our own portfolios, but we would have learned something about distribution. Probably would have meant that we wouldn't have been able to do any lending, but we could have at least validated demand for it, and lots of different ways to get there. But yeah, I think we were lucky at that point, and it enabled us to go and do the harder things ultimately.
And how does that regulatory process and compliance broadly differ at something like Sidekick versus Tandem, for example, when you were there?
In a bizarre way, I actually think it's a weird thing to say. I actually feel more like the severity, the regulation of a bank is different. I don't think it is. Like I actually feel that the regulatory footprint that we have at Sidekick is so much more complex. So running a bank is hard. Running a bank is rigorous. You have systemic risk if you get it wrong. You have like the bar and the stakes are so high. The bar and the stakes are very high, clearly, still in lending and investment. But I think it's different because it's just breadth. So we do savings products, we do investment products, we do public markets and private markets. We've got lending. Like there is no one compliance officer that can know every single bit of regulation across all of that full breadth. So like maintaining discipline, maintaining like rigor across such a broad spectrum of the regulatory landscape, I actually think is weirdly harder than banking regulation, which
because you're so like deep into
exactly.
Okay.
Yeah, exactly.
Interesting. So how now at Sidekick are you dealing with dipping your toes into quite a breadth of different products, regulations, that footprint you mentioned?
Cautiously.
Yeah.
Yeah, I mean, like it is. We are in the business of regulation. At the end of the day, you can do huge customer harm if you sell an investment product to the wrong customer, or a customer doesn't understand what they're buying, or if you leverage someone's portfolio and they use it for the wrong purposes. Like there is a lot of harm that can be done. So it is from day one we have embedded regulation into like the culture of Sidekick as well, and it's always a hard one because you see some of the biggest businesses that are built globally, and there's always some kind of slightly psychopathic founder who just goes and breaks all the rules and kind of cuts every corner and somehow gets there fast, and that just doesn't work. It just doesn't work in this space. And like those that have, it'll come back to bite them at various points, because again, you're in the business of regulation, but not just to please the regulator, but also because if you're not regulated and if customers don't trust you, no one's going to give you any money anyway. So cautiously is the right way. And we've spent a lot of money on lawyers, and we've spent a lot of time focused on getting it right. So I think hopefully that will pay dividends over coming years.
How do you, a similar problem for the regulators maybe, but how do you balance like that innovation piece, like not cutting corners but doing things differently, creatively, whilst staying compliant? Like, are there threads or common practices that you've kind of seen work quite well when trying to do that?
So it does make me sound old now, but Parity, when we did this partnership with HSBC back in, I think it was 2015, way too long ago now, we were part of the first ever FCA sandbox.
Okay.
And that genuinely, it kind of makes me sad that they don't still have it in the same form as it was. It was the perfect environment, because basically it wasn't compliant versus non-compliant. Like, that's not even a question. You're building compliant products. But if there's ever a question about how the regulation can or should or doesn't apply, the best thing you can do is just narrow the, minimize the impact. So minimize the scope. So we launched this auto saving, auto investing type product with HSBC. And there was a big question, which is like, if you're buying £1.20 of an investment product, or if you're doing something in a much more automated way because we were like automatically saving basically on behalf of customers when it looked like they could afford to save. Like, if you're not showing them the kid every time, or if you're not like proactively getting them to initiate the transaction every time, if you're doing that, how does the regulation fit into that? Like, how does a customer stay on top of the risk? So what we did was we ran a pilot and we gave it to 200 HSBC customers. So like, we built the whole thing, we did it openly, met the regulator on like a weekly, bi-weekly basis, shared all the data with them. And like, the best way was, hey, look, we're going to build a thing. There's some unknowns. Let's have a look at those unknowns together, and let's give it to 200 people, which is not going to cause mass harm. There is always the risk of harm, but like, if you minimize that, then we can learn something. And then if it works, amazing, open it up. If it doesn't, then you can remediate. So I know that there is a sandbox, and it's
in it.
Are you in the sandbox?
Yeah.
What's your perspective been like?
Not like that. As in, I think it's helpful to be as close to regulators as possible, and we really tried to. And we've done things like publish case studies about how you can leverage AI in your compliance processes and stuff like this. But access to a customer, for example, building openly that constant kind of weekly dialogue, and then piloting hasn't been something we've experienced. But I think it's because of the success of the sandbox. Probably in previous iterations, the demand and volumes just got higher, and it's just a bandwidth thing, I imagine.
It's I really think very fondly of it. But also, there were so many great people that were part of that at the time that have gone on and done amazing things, like almost outside of the regulator as well. So I think you've got to get that combination of timing and people and everything all in the right space. But I mean, that would be myself genuinely if I was like working at the regulator. It would be safe spaces to pilot.
There's an exciting AI lab which we've applied for.
Oh, nice.
So I'm kind of hoping that'll be like the sandbox, but supercharged, specifically for AI companies.
There's some really good stuff coming out of the regulator at the moment. Is that the one with the NVIDIA?
Yeah, exactly.
Yeah, I think that would be amazing.
Yeah, it'd be exciting. As we're on the topic of AI, we have to touch on it briefly. How do you look to leverage AI, if you do, at Sidekick? How do you see the market for it in the future? Just, curious on your take.
Yeah. I mean, we use it all over the place, literally kind of finding every single opportunity to use it to drive out cost, make things more efficient, make things faster. We haven't used it as much at the front end in the customer experience, although we have leveraged it for like customer support, less on a chat perspective, more on like how do we surface the right information through FAQs and things like that. But it is the future. If every single business is not embedding it across everything that they do, then they are going to be missing out. I think that the biggest open question I've got on in our space, at least for AI, which I think is kind of the big one, is financial advice, basically. So, if you look at these industries, and I've almost putting my VC hat on a bit, I've been really trying to think which are the industries that are going to get fundamentally disrupted by this versus enabled. Financial advice for me on paper should be one that is like fundamentally disrupted, because at the end of the day, without speaking too badly about the advice industry, but it is, and I've partaken my financial advisor qualifications to at least not kind of bullshit about this, that it's a pretty prescribed set of recommendations. It is not rocket science at all. It is about like understanding the customer's needs. It is about capturing that, and it's about matching that with a solution that's out there. All of those things are completely solvable through AI. The relationship bit, perhaps less so, but again, digitally native, AI first consumers, are definitely going to go that way. So I think the practice of delivering good financial planning, good financial guidance, and ultimately good financial advice is something that AI can solve and will solve, and kind of is already solving to some degree. But the regulatory barrier is the one that I think is the big question, because ultimately in such a regulated space, it is humans, it is individuals that need to be authorized to do these activities. It is humans that are ultimately accountable for recommendations. So I think that's going to be the interesting one, is like who can get the qualifications, can get the regulatory permissions, can take accountability, but ultimately enable, kind of not outsource it to AI, but have AI do it. And no one has cracked that yet. And I would love to run at that space. So
essentially something within financial advice, the ability to get instant sort of advice across a range of products in a regulated manner, basically leveraging AI.
We are a very long way away from that, because again, going
is that
back
a cultural thing or a technology thing?
It's the risk of harm. It kind of goes back to what I was talking about before with the FCA sandbox and things like that. That might be actually, if someone is in your AI sandbox, I think that would be a perfect thing to run through there. But the idea that AI could autonomously have a look at someone's situation and recommend something that could cause material harm is that is the risk around it. So I think there is a big regulatory gap between fully autonomous AI driven financial advice and tooling there to support advisors to be more efficient. I think we're more on the latter at the moment, of like more efficient advisors but still with humans accountable. I really want to see someone win in that space, and we are not regulated to do financial advice. We're a wealth manager, not an advisor, but I see massive opportunities inching towards that over time.
Okay, interesting. Going back to, taking a high level view of your journey in entrepreneurship, I suppose, did you always want to be an entrepreneur? And then you talk a lot about riding through setbacks, for example. How important is resilience, emotional kind of grit, determination in that journey?
I don't think I always wanted to be an entrepreneur, because I didn't know what it is. I don't ever remember it being like a thing. You want to be an entrepreneur, like run your own business or something. That's fine. But
so running your own business and being an entrepreneur is just two different.
Like, I just don't think I'd ever really thought about it as a kid, like in that way, like it was a career. Like I was always setting up something small and stupid. I was always like setting up a miniature business. Because like a 16-year-old, it makes me sound like a loser, but I set like
that's the same
customizable golf club website up that, like crazy. I don't know what I was doing, why I wasn't just going and kicking football around like everyone else, but I was always trying to make some money by making a thing and trying to sell a thing, whatever that was. And for me, that was really exciting. Like but I never saw that as this is going to be my career. This was just like, I really enjoy creating stuff, selling stuff, and making these things work. So I joined consulting, which is probably the career for everyone who doesn't know what to do. But,
Okay.
Yeah.
So that was like the kind of natural. I know I really like doing stuff, but I don't see it as a career. I'm kind of smart. I'll just go into consulting. Do you think that's a path that?
Probably. I have no idea. Again, like, who knows what a consultant is at that age either. But knew I didn't want to be a lawyer at that point. Knew I didn't want to work in investment banking, and it was kind of the other one. It sounded quite interesting. Strategy, in inverted commas, sounded quite sexy at the time. I didn't realize that PowerPoint could be quite dull. But yeah.
Why finance then after that? As in, like, because obviously I think the common thread between your consulting, VC, and then startups is banking and open finance and data and this sort of stuff. So where did that come from?
Completely accidentally, again. So I did about 4 years in consulting, then left consulting. The irony actually was I left consulting because at that point I just got promoted, but they were like, you can be promoted if you join the financial services team. And I was like, screw that. I do not want to work in financial services. I want to work in media and entertainment and tech. That's where it's cool. So I left consulting in a bit of like a strop, I think, at the time, that I didn't want to go and advise in insurers and large banks. So I joined a media company in their internal strategy team. So big media group. They owned like lots of newspapers, online, like lots of different online sites. And I was in the strategy team, and like one of the companies. So we acquired companies, we managed companies. It was like a portfolio role, but also built companies as well. And On Trees was a startup that was built out of that group. So it was more like a chance of, hey, this is cool. We can build something interesting in a space that, like, I was always interested in personal finance. So a slippery slope down, and then all of a sudden you become a fintech person within a few years.
Nice. If you were giving a piece of advice to fintech founders, what would it be?
Oh, I mean, it depends who.
First time fintech founders.
Yeah, first time fintech founders. It's a really good question. I think it's changed a lot. Like, it has changed a lot. I think like 10 years ago, everybody wanted to be in fintech for some reason. I have no idea why.
Especially in London.
Yeah, it became so cool to go and work in fintech. Kind of crazy, really. But I think there were lots of people who wanted to be in the space but didn't necessarily know what the right businesses to build were. So there were so many copycats. Like, I remember in the Parity days, there were like 5 versions that came all pretty quickly after. Like, do you want to work in fintech? Do you want to work in a startup? Do you want to have a MacBook? Is that the thing that you care about? Or do you want to go and solve like a really big customer problem? And like, like Parity didn't particularly work out. None of those businesses really worked out either, because they were kind of a solution looking for a problem. But like, fintech and financial services is hard. It is slow. It is grinding. It is difficult. So I think advice to a first-time founder would be like, focus on a problem you deeply care about and is big enough that you can go and figure it out over time. Don't just look at the shiny thing, because I mean, we're past that wave now, thankfully. But I remember having a stack of about like 60 different prepaid cards, and like, nobody needs another prepaid card.
Yeah.
So solve a problem that you really care about, because you're going to be in it for 10 or 15 years. It's going to be way harder than you think, and make sure that it's a real customer problem that you're solving.
Cool. Well, maybe final question. Were there any questions I didn't ask, or any topics you wanted to dive into for 1 minute, 36 seconds?
So like, we touched on AI. Where do you think the biggest opportunity, beyond AdClear, of course, where are you placing your bets in the AI space?
I think putting my VC hat on now, but also combining with what I've seen at AdClear, it's the combination of automation, so it's delivering like time savings, valuable kind of ROI, but also freeing people up to do more creative tasks and just the movement of the workforce. So moving people into higher levels. One of the reasons we started AdClear was my mum actually was in regulation, and so for 30 years of her life she did basically clearance within radio advertisements. And I always think she's a smart woman. What could she have done if she had AI at her disposal
Yeah.
and moved in, further deep in? She's a successful woman, but what else could she have done?
Yeah.
And so that's why I think AI has a real opportunity, is to free up labor, especially domain expertise people who can do other things with that knowledge.
Yeah.
Obviously, within AgClear, we think that's in compliance, but there are obviously huge other opportunities.
So the world's going to get more creative rather than more unemployed.
Exactly.
Cool.
Nice. Thanks, Matt. Thanks for coming on.
No, thanks for having me.